I'm Jeni Browne. Welcome to this week's edition of MFB News. I hope everybody is tip-top and had a fantastic week. I'm very good today. I'm actually off to Paris this evening. I'm so excited. I haven't been away for like 7 months or something. So a couple of nights in Paris. So that's why I'm so chipper, not because of the interest rates and what's been happening in the capital markets. And we'll come on to that in a moment. And on that note, what are we going to be talking about today? We're going to be covering off the latest on swap rates and how that's impacting mortgage interest rates, and also doing a roundup of where pricing currently sits. We're then going to be talking about one of the latest pledges that have come out in the Conservative Party manifesto, definitely one that I think is worth flagging with you. It's probably more of a point for discussion than anything else. So as always, if you want to leave some comments, and some of you have been leaving some fantastic comments on the video recently, I can see that politics is definitely something that gets you kind of your blood flowing, and this is another one that we can obviously talk about. And then finally, I'm going to dig into an economic report that I read last night, because that's what I do on Tuesday evenings. I like to read economic reports. I'm that interesting. Don't ever have me around for a dinner party. And we're going to talk about some of the data held in there, because actually it is really, really relevant to you guys as property investors. Swap rates. Okay, so we know they've been hovering 5-year swaps at around the 4% mark. They were slightly over. Actually, earlier this week, they went down to 3.95 something at one point. As of this morning, 5-year swaps are at 4.145, so they've gone up again. 1 month ago, they were at 3.964. So although I think psychologically, because it starts with a 3, it sounds like a big difference, the reality is that we're talking 0.2% difference. So frustrating, but actually, we're broadly the same as where we were a month ago. Interestingly, 1 year ago, 5-year swaps were at 4.601. So we are in a better place than we were 1 year ago. 2 years, very similar story. Currently 4.665. 1 month ago, 4.492. So again, they've gone up by sort of like 0.2%. And 1 year ago, 5.171. So the good news is that we're definitely in a much better position than we were one year ago, but not necessarily, we haven't really progressed. So really frustrating actually. So actually, I think if I was going to kind of summarise where swap rates are, it's the same as it's been last week and actually for many weeks previously. And we are expecting some inflation news to come out shortly. That may make some sort of dent in the figures, but actually I think there's just so much kind of uncertainty with the election. There's stuff going on in Europe now as well. We had the GDP news out, and we'll come on to that a bit later on as well this morning, and that's going to not have helped things. So I think it's just there's lots of different things in the mix which are really kind of slowing down any kind of recovery in the capital markets in terms of cost of funds, which in turn leads on to mortgage pricing. And this is why we're not really seeing mortgage rates definitely not coming down. There's lots of people that are calling us up at the moment and saying, yeah, I've heard rates are coming down, so you know, what's the rates now? And then we tell them, and they're like, they haven't actually come down, or they're more expensive than they were. That's why, guys, it's because the cost of funds has not really changed or potentially gone up depending on where you're kind of benchmarking time. So in terms of what lenders have been doing in the last week, it's been very quiet, as you'd imagine. There have been a couple of lenders who have repriced upwards. Only one lender has priced downwards, and I actually wanted to talk about them very briefly because they're a very interesting lender. So quantum mortgages are a relatively new kid on the block. They haven't been around for terribly long. And I think it's fair to say that they aren't the cheapest lender by any stretch of imagination, very much a specialist lender. So they're lending on, you know, limited company stuff, HMOs, multi-units, quirky things. But they do have a couple of really good strings to their bow in terms of their lending policy. So the first one is, if you're doing a like-for-like remortgage, they don't stress test at all. So that's really interesting. And that kind of fits in with the spirit of the guidance that's set out for lenders. If you're doing a like-for-like remortgage, you're remortgaging from one lender to another, and you're not raising any money, so the amount of debt is staying exactly the same. These lenders are able to flex or offer flexibility on their rental calculations, and Quantum are very much capitalising on that. The other one, which I think is more interesting, is that when they are looking at your mortgage application, and also when we get to legals, they're not going to ask for sight of the AST, so they don't mind who you're letting the property to. Now, we're definitely seeing an increase in the number of landlords who are looking to let their property out to limited companies or to businesses who will then sublet the property out from there to places like Serco. So they're essentially doing things, letting people live in properties, and where it becomes sticky is when the tenants will be classed as vulnerable. So think of things like people with learning difficulties, people who are in sheltered housing, that kind of stuff. So actually Quantum are a lender who can potentially take on a case like that. You will find that if you're going to a lender and you're actually going to let the property to a charity or a company that are letting vulnerable people stay in the property, you're going to really struggle, but Quantum are definitely one to consider. And so the reason that this is kind of relevant, I guess, is that they're unique policy, but also they've just dropped their rates down by a whopping 0.8%. I mean, they're still not cheap by any stretch of the imagination, but they certainly fill certain gaps in the market that other lenders aren't willing to play in. So that's quite interesting. So one bit of good news there this week. So in terms of pricing and how it's shaking out, so I'm just going to do a roundup of where things are sitting. I'm going to do my usual thing of saying the rates I'm going to share with you now, there are cheaper interest rates, but the arrangement fees on these are massive, like 5% of the loan amount, 9.99, not actually 10%, we haven't got that one yet, but 9.99% of the loan amount. So some of the arrangement fees are enormous. So what I've done is I've only picked out the rates where the arrangement fee is 3% of the loan or less, because I think that's where some people can find it palatable, is probably strong, but people can kind of get on board with it. So if you're an individual, looking to mortgage a straightforward property, so no HMOs, no multi-units, anything kind of racy, your 2-year fixed rates are starting from 3.94% with a 3% fee. If you're a person and you're looking to refinance a straightforward property on a 5-year fix, your pricing is now from 3.96 with a 3% fee. Limited companies, 2-year fixes 5.09 with a 3% fee, and 5 years from 5.15 with a 2% fee. So that's kind of where things are at the moment. In terms of how quickly we're expecting things to change, it's actually very hard to say at the moment. There's still, I think people have largely ruled out a base rate reduction in June now. People are still very much talking about a base rate reduction in August. But I think the reality is that we kind of need to move further forward with the election, get some more inflation data, and hopefully things have kind of settled down more broadly in Europe. And we might then start to see the money market start to calm and start making reductions. But at the moment, I think the reality is that if you're hanging out for a much lower fixed rate, you're going to be waiting until the autumn now. Okay, now I read an article yesterday which I found really interesting, which was about some of the pledges from the Conservative Party related to housing. So the big one is that the Conservatives are saying they're going to scrap capital gains tax for landlords who sell to sitting tenants. So essentially, if you're renting your property out to your tenant and then they decide to buy the property from you, you would not pay capital gains tax on the sale of that property. And this scheme is going to proposed to last for 2 years. The objective here is to try and encourage more landlords to sell to free up housing stock, and also benefit long-term renters by increasing their chances of getting on the housing ladder. Now, I read this article and I thought that was a really good idea, actually. I think there are lots of landlords who are thinking about selling, but actually capital gains tax can be really crippling. There are some people who actually can't afford to sell their properties because of the capital gains tax bill. So this could be a massive help for them. But actually, in the reverse of that, what the Conservatives are saying kind of more subtly is, we're happy to forego having a property available in the rental sector if it enables somebody to be able to buy their home, i.e. they're favouring home ownership and first-time buyers over landlords. And some landlords will actually just sort of feel this is like another message to landlords that they're just not really wanted. Now, the manifesto does talk about a couple of other things that the Conservatives are looking to bring in. The first is the return of Help to Buy, which means that buyers would have to have a deposit of only 5%, and the government would effectively provide a loan worth 20% on top of the borrower's 5% deposit, which means that essentially the mortgage itself would be 75% loan to value. This is a scheme that has been in existence. It was actually very good. So bringing that back in, I think, would be really fantastic. And the other thing they've talked about is permanently abolishing stamp duty for first-time buyers on properties of up to £425,000. Now, this is currently in play, but it's due to end in March next year. So this would be essentially making this a permanent feature. How do you guys feel about this? It's very, very interesting. People sit on the different sides of the fences, and actually, as an example, the bringing in of the ability for landlords to not pay CGT on the sale of a buy-to-let to a sitting tenant. Some landlords are actually going to really like this, and some of them are going to really not like it. So it'd be interesting to see your views. Do share them in the comments below. We really love reading them. Okay, so this morning, I'm sure a lot of you woke up to the news that GDP did not change in the most recent month. So actually things have kind of essentially flatlined. So actually talking about an economic report that I read last night feels quite opportune. So the report, and just to be kind of clear here, economic reports are the opinion of one or a group of economists. It is not necessarily fact, it doesn't represent every economist's opinion. This is just kind of one view on the market. So the report, first of all, talks about interest rates, and obviously as people that borrow money, the fact that you watch this video at all tells me that you're interested in interest rates. This part is particularly interesting. So what they start off by saying is that GDP growth was strong in Q1 2024 and inflation dropped sharply in April on the back of lower energy bills. But with wage and service inflation proving stubborn, a cut in interest rates before August now looks unlikely. So base rate coming down before August, probably off the table. To dig into service costs for a moment, this is currently close to 6%. This is largely impacted by mobile phone and rail fares. So mobile phone and rail fare inflation is still at 6%, which is kind of holding things back. Markets are no longer pricing in to 0.25% base rate cuts this year, and expectations of the pace of easing have been pushed out in the next few years. So what they're essentially saying here is that whereas previously we were expecting 2, maybe even more base rate cuts this year, that's gone down to 1, and the rate at which base rate will come down going forwards beyond the end of this year has also been pushed out, and that could be contributing to why we're seeing the swap rates kind of getting stuck at where they are. Now moving on from here slightly, economies are coping better than expected with higher interest rates. Economists have no great certainty around what the correct long-term level of rate is. So essentially what they're saying here is what is a normal sort of good level of base rate, and actually at the moment no one knows. The ultra-low rates of the past may have been a mistake that distorted asset prices and investment decisions. Rates could fall by less than expected. Given this, there are still questions to be asked about the valuations of residential and commercial property, but the risks feel less acute than a few months ago. So I think what we're essentially going to take from this is that we've all become very, very used to super low interest rates, and that has kind of potentially distorted the market. But actually, what is going to be the normal going forwards? And that's the bit that I think people are really struggling to call out. I think, you know, in my mind, 5% base rate was kind of what I entered the mortgage market 27 years ago. And that it was always kind of around that level. So I don't know, I think in my mind 3.5% to 4% probably feels like a good kind of level, but who knows. Okay, housing market now. Good news, sellers are returning. Given the depressed state of the market over the last year, the need to get on with life may be surfacing. Sensibly priced property is selling quickly. Rightmove report a strong, seasonally unadjusted rise in asking prices in May, led by larger properties. Nationwide properties based in approvals also edged up. There is a growing disconnect in what affordability measures suggest about the path of prices and reality. Our view, and this is the view of the economists, not my view, is that where the mortgage rates are and with the supply rising more than buyer inquiries, house prices will drift down. So essentially, mortgage rates aren't looking to go down super quick anymore, and there's lots more properties coming to the market, but the number of people looking to buy is not increasing at the same rate, which means there's going to be a kind of surplus of housing stock for sale. And also with the kind of cost of mortgages, what they're predicting is that house prices will ease further. However, some are making upside cases. Savills expect prices to rise by an average of 2.5% in 2024, 3.5% in 2025, and 21.6% in 26. That forecast assumes interest rates decline rapidly, and that's kind of unknown here, I think. The longer that does not happen, the greater the chance for more abrupt stop for both the economy and the housing market. Okay, so the rental market now, while it feels that the ceiling of what tenants can afford to pay must be near, rents are still rising, and we know that, don't we? And surveyors expect this to continue even in London. The market clearly is tight. Tenant demand outside of London is rising and new tenant instructions falling. Tenants are renting smaller places in less convenient locations, but they are also presumably cutting back spending elsewhere to meet the higher cost of housing. There are significantly more private sector landlord possession claims than pre-pandemic. Essentially what that means is that more landlords are kind of getting repossessed rather than taking possession of their rental property from non-paying tenants. Temporary removal of property may explain some of the supply-demand imbalance, but it is not obvious that these properties are being sold to first-time buyers. The economics of the investment is still a big constraint. There are 60,000 fewer buy-to-let mortgages outstanding than there were 1 year ago, probably more reflective of a lack of new sales than landlords selling up. The Renters Reform Act didn't make it into law. Labour may have bigger immediate priorities, but it's hard to believe they won't bring in a more tenant-friendly regime. So I think, again, the kind of conclusion here is that actually the expectation is that rents are going to continue to rise. Demand is still outstripping supply. There are less properties coming available on the market. There are less buy-to-let properties around, full stop. and therefore that's going to continue to drive up cost. And what they're seeing is that tenants are kind of making adjustments to where they live and their lifestyles to be able to afford to continue to pay their rents. And lastly, on GDP, and this just feels quite opportune because of the news that came out this morning. Although households are less pessimistic, the persistent weakness of consumer spending highlights just how much more of income is now spent on essential items like food, energy and housing costs, leaving less for discretionary purchases. Households may need more time to build resilience. Nevertheless, rising real wages should underpin a modest, more durable recovery through 2024, with GDP growth of around 1% this year and 1.5% growth in 2025. Inflation may finally reach its target in July, but is expected to end the year at 2.25%. So there you go. I hope you're still awake after listening to that. But I hope that just gives you kind of a flavour of how the economists are viewing all the kind of various segments of the market which kind of really directly impact you as property investors. And that's us wrapping it up for this week. Thank you again, as always, for watching. Hope you found that helpful. I really want to be back with some amazing news and be singing and dancing about the fact that interest rates have come down, but it just feels from all the things we're hearing, and hopefully that economic report kind of makes you or brings it all together into why we're not really expecting anything to change in the near term. But as soon as it does, obviously we'll be the first to let you know. But you know, we are still seeing people borrowing money. It's not like it's all doom and gloom. Actually, you know, some people have to refinance. You know, they don't have a choice. Other people are still investing as well. So the market is still active, just maybe not as active as it was a couple of years ago. So on that note, if you did have any questions, we'd love to hear from you. 0345 345 6788. And our website is full of fantastic information. I'm going to hotfoot it to Paris now. So I will see you same time next week. Have a wonderful weekend and I'll catch you next time.